Please begin.
Good morning, everybody. My name is Andreas Park, and I welcome you to this Rotman School of Management live stream on the topic of challenges of lending to small and medium enterprises in the pandemic, the role of Canadian alt lenders. I am a professor of finance, associate professor of finance at the University of Toronto, Mississauga, and I'm cross-appointment to the Rotman School. And I also serve currently as the research director of the Rotman FinHub, which is our financial innovation lab. The FinHub welcomes you to hear from our subject matter experts on challenges of lending to small and medium enterprises. And we thank you for your interest in this event. Now, when we talk about alt lenders, we are referring to fintech lenders in particular, not to something like payday loan lenders or the like. We're talking about tech companies. Now, the Rotman FinHub, as some background, is a research institute at the Rotman School. We think of ourselves as the Financial Innovation Lab, and we're funded by the Rotman Catalyst Fund, TD Bank, and the Global Risk Institute. Our main objective is to expose and instruct students in cutting-edge technology and financial innovations to develop new research insights that drive our understanding, that drive the teaching, and that also help industry in making Canada a better place in the financial sector. And and this is why we have these events, we provide a forum for the exchange of ideas between academics and practitioners on topics centered on financial innovation. Now, what we're talking about today is loans that happened during the pandemic with the help of the Canadian government. The Canadian government has acted swiftly and decisively to support the economy, in particular, including small and medium enterprises, with an eye in particular to help keep people employed. Now, that being said, in Canada, the alternative non-bank lenders or fintechs have been excluded from assisting to facilitate the government-sponsored pandemic response programs. Now, we will talk a little bit about the US program where fintech lenders have not been excluded, and we try to understand better what the difference between the programs are and what the experience so far has been. Our expert panel will discuss the issue of why in Canada alt lenders have been excluded and whether or not this is a positive or a negative. Now, the answer may be something along the lines of that these lenders are not qualified or sophisticated enough to participate, that the government lacks trust in them, perhaps that the exclusion of these lenders from the space will in fact constrain and restrict the development of the innovative sector in the future and also exclude certain entities and certain businesses from obtaining badly needed funds. But we also may see that maybe this was just the easiest way to handle the program. Now, we will hear from both practitioners and from academics on this topic. And I will first start with a presentation from Dr. Julapa Chaktiani, who is a senior economic advisor and economist for supervision, regulation, and credit at the Federal Reserve Bank of Philadelphia. Julapa is an ideal speaker on this topic because her research focuses on fintech lending, in particular peer-to-peer lending, but also on small business lending. Julapa earned a PhD in finance and an MBA from NYU Stern School of Business. She held the Rockefeller Foundation Fellowship at the time. She has been with the Federal Reserve Bank of Philadelphia as a special advisor in the Supervision, Regulation, and Credit Department since 2008. In her role, she has conducted research and participated and led several supervisory policy and implementation projects, including recovery and resolution plans, Basel II qualification reviews, and so on and so forth. She has made very significant contributions in the field of financial institutions, financial markets, and bank supervision and regulation. She publishes in top research journals. She organizes conferences. For instance, she has an annual conference in Philly Fed on FinTech, which is attended by academics and practitioners from throughout North America. She connects regulators with academics and industry leaders, and she's a frequent speaker at conferences and forums. Her research areas include banking policy-related issues, including too big to fail, systemic risk, financial stability, Basel II capital regulations, mergers and acquisitions, risk models, and management. Her most recent research has focused on issues related to fintech, and she is a pioneer in the field and has created very important insights for all of us using specialized data and cutting-edge technology. She tries to understand better what role AI and machine learning plays in credit decisions, in particular in small business lending and community bank mergers. Now, what Julapa will do is she will talk about the US experience, and she will give us some background on the Payment Protection Program, the PPE program. Julapa, thank you for doing this. The floor is yours.
Can you see me? Good morning, everyone. I'm excited to be talking about this topic. Thank you very much to all the organizers for inviting me. By the way, today, everything that I say today is my own view and not the view of the Federal Reserve Bank of Philadelphia or the Federal Reserve System. So I'm going to share my slide, right? Okay, you all see my slides? Hello?
Yes, Julapa, we can see your slides.
Okay. So I'm going to, as Andrea said, I'm going to start by giving you some background on the landscape of small business lending. This is based on the US market. And also we'll talk about the roles of fintech in lending in small business, and also how fintech lenders could potentially expand credit access to those what we call underserved or invisible prime or hidden prime, and without taking additional risk. I'm going to also talk about the US experience with the Payroll Protection Program, the PPP loans in the US. So to get started, here are two plots from using US data, banking data from Call Report. And we all know how community banks are known to be committed to their local small business owners. They're good at collecting soft information, but basically about business owners, local business owners. And you could see from the left figure here that in terms of ratio of small business loan to total assets, the blue line here, community bank ratio, far exceeds the ratio of large banks. Although the ratio has been declining over the years from 1997 to 2018, but it's still the entire period, it far exceeds the ratio of large banks. But when we look at on the right side, when we look at the market share, actually we find that the market share that in the small business lending within the banking industry actually has been shrinking for community banks. And the large banks, which is the purple bar here, you can see that it has been growing market share. And this may be driven by business cards that was introduced in around 2006, 2007. But more importantly, its small business loans actually have been leaving the banking sector to the non-bank shadow banking sector. And fintech is part of that. So we're going to see the fintech lenders started with small personal loan, consumer lending platforms, but they expanded into small business, mortgage, and others. And people often ask me, okay, so who go to fintech lenders and are they charging more? So I would say that they're not all the same. There are many different business models. So for small business lenders, we can see that some of them are P2P, they match borrowers and lenders, so they don't take any risk themselves. And so, for example, during this pandemic, the crisis, these type of lenders will not be taking any default risk because investors are taking all the risk, right? The second type would be those that actually hold these loans on their balance sheet, they fund it themselves. So those would be exposed to default risk. And the payment processors are kind of in between. So they actually have more information about the borrowers through their payment data on their platform. And usually they would take a payment out of the cash flow that comes through their payment platform. But besides these business models, there are also many different products that fintech small business lenders offer. Some of them offer larger loans for longer term, and many of them actually limit themselves to 36% limit APR. But there are others that focus on serving those that have liquidity needs, and so they would offer much smaller loans at very short term, could be 30 or 90 days, or a little bit longer. So so when you convert this interest rate that they charge into APR, it could be extremely high, like well above, well in the 3-digit APR. And so they're quite different. And so many different products, different business models. Now, back to community banks. So we know that before COVID, we have seen that the ratio, the commitment has been declining and the market share has been declining for community banks. But during this pandemic, it turns out that a lot of business owners that had relationship with both large banks and small banks, actually many of them struggle with large banks, but those that didn't have account with small banks, actually many of them open account with small community banks and actually were successfully receiving PPP loans through small banks. And many of these small banks actually also partner with fintech platforms to help them with KYC, AML, or whatever, and share the fees. So there has been talk about the rebirth of community banks in small business lending because of this pandemic, through this pandemic. So back to the roles of fintech in small business lending. Are they going to be able to expand credit to those underserved, actually? So there is this very recent paper that just came out and look at, perfect for this talk, look at PPP, look at the response of fintech and non-bank lenders. And they interestingly find that the borrowers are more likely to get fintech loans in the zip code, very granular, look at zip code level, where local banks are not likely to originate the PPP loans. So this clearly supports of course, if you're looking to see whether fintech could help, this supports that decision. But this also is consistent with one of my papers that was published in 2018. It was focused on consumer lending, fintech consumer lending, lending club data. And I also found that consumer lending by fintech lending club particularly penetrate areas that would be underserved, classified as underserved based on many different measures such as market concentration or banking activities. So we see that evidence in both small business and consumer lending by fintech platforms. So now to answer popular questions of who actually borrow from fintech. As I said, there are many different products and it attracts different kind of borrowers, customers. So I'm fortunate to have data from Lending Club Small Business Platform, which is not available on the website, not unlike consumer loans. But we could see from this plot that on the left here, that we could see that there are a lot of business owners that would be, by traditional measure, FICO score, would be classified as below prime, and actually significant number of them actually go to a lending club to get funding. And also in terms of how badly they need credit, we look at the number of credit inquiries during the 6-month period before there is apply for lending club loan. And we also find that a lot of them actually seem to be in need, because they submitted more than 3 credit inquiries in the 6-month period prior to going to lending club. And also, mostly they are very small business owners with 5 employees or less. In terms of interest rate, see also, this is based on lending club and funding circle, small business platforms. And you can see that interest rates are well below the 36% limit that, that they have set for themselves. This is on average. But then we look at the more specific, more granular level, we can see that, so if borrowers, if business owners are classified as good credit by lending club with R1 rating, interest rate that they pay is actually very low, 10% or less APR. Now, if you look at by year of origination, you could also see that a lot of them with this orange color here, they're actually, these are the loans that pay less than 15% APR based on for different years of loan origination. So, and of course, this is just one platform, but it shows how a fintech could actually open door for these small business owners that may be in need of funding and may not be able to get funding elsewhere. So how did they do that? How did they actually make loans to the underserved, low FICO score, charge a pretty good rate, and are they taking too much risk? How do they manage to not go out of business so soon? So here is the trick. So there are, I have done some research that look at the use of alternative data and complex modeling to basically, by relying on more data and more complex modeling, there is a way to hopefully identify those borrowers who are what they call invisible prime, those who actually are not they're actually credit worthy, but doesn't seem to be reflected in their FICO or Vantage score. So these are the 2 pictures from, of course, this is based on data that I have, a lending club. The left figure here is for small business loan, and the right figure is for personal loans. And this plot shows the correlation between the ratings that lending club assign as of the based on the qualification quality of the borrowers relative to the traditional rating by FICO or Vantage score as of the same date as of loan application date. And you could see that this just shows that more and more over the years, more and more information used and more model gets better and better. So the correlation between these 2 factors, FICO rating and the lending club's own rating, has been declining significantly over the years. For consumer, particularly for like about 80% to only about 35%. And for small business loans, about 55% to also about 25%. So that shows that there is a lot more information that's not already in the FICO score, and the FICO score is mainly used for traditional lenders. So again, and this is this page here is based on consumer lending, but it just shows how this blue part here are basically FICO score less than 680, which is say below prime. And we can see that some of them get pretty good rating A and B by Lending Club. And when we follow them throughout the 2-year period after they received the loan, and we can see that those that were rated A and B, although they had very low FICO score, they actually didn't default. And when comparing with the credit card rate that they borrow to pay off credit card, actually there is a lot of saving. Now, I'm going to then talk about the PPP. So as Andrea said, that so this is basically the goal is to provide relief to small businesses so that those that would have survived would not have to file for bankruptcy. So help them sustain their business and keep people on payroll. So a lot of money went into this program. Now, fintech actually, although in the beginning, they were not approved until towards the end of round 1. There were 2 rounds that we saw earlier. So at the end of round 1 here, several fintech platforms, small business lenders were approved to originate the loans. So there are different ways that they could get involved. They could originate the loans themselves, but prior to being approved, they could also do it through partner banks. They could also, with a smaller fee, they could help with the KYC, AML, and also a lot of it's a very confusion and a lot of confusion and very hectic because all this gets done in a very short time, and nobody was prepared for that. But so many of them work with banks, a lot of banks, and actually help to originate the loans as much as they could. They asked more and more of them got approved through the later in the second round. Let me go to who received the loans. So I have this data that I've seen from Funding Circle. This is a smaller because we saw from here that Cabbage actually made a lot more loans, and partly just not origination, but working with partner banks. So the fee was not 5%, but still it helped to sustain them throughout this recession period. Now for Funding Circle, it's interesting to see that also quite a lot of minority and women-owned business actually received the loan through Funding Circle. And many of them are new customers. They're not existing customers. 65% are new. There's a study by the New York Fed that look at where PPP loans go. But this is look at less granular level compared to the previous study that I quoted earlier. So this look at the state level and find that the PPP loans may have missed some of the hardest hit based on coronavirus cases. Interestingly, fintech lenders, although many of them are small, they're not eligible for PPP as a borrower for PPP loans. So many of them had to lay off or furlough their employees. So to conclude, to answer these big questions of whether fintech actually should be allowed. So first of all, I would mention that it is very important as much loan as possible should be made, but how would they fund these loans? So although this PPP is a SBA program, the Federal Reserve in the US set up this liquidity funding to support all the lenders, not just banks. The facility has also been expanded to include, to make it available for non-bank and fintech lenders. So, and fintech, even if they don't originate the loans themselves, they could help significantly with the technology to reduce fraud, so far a lot of the fake ID and also multiple applications. People could apply for 5 different loans at different lenders, and it could create a lot of inefficiency and confusion. So fintech could help with that. And also, because of this, so much demand for these loans, and within a short time period, so much loan has to be made. So even banks themselves are hitting with their own constraints, liquidity, capital, and time constraint. And a lot of it also, the process is new. Some of it has to be done manually. And so with this constraint, fintech definitely could help to at least, because banks would have to focus on their existing customers, given all the constraints. Fintech could fill the gap by serving those mom and pops who don't have banking relationship, and so they're not left to file for bankruptcy. And so one thing that I would also mention that this forced partnership between bank and fintech actually has already helped to expedite digital transformation in the banking industry overall. Many of the banks were not capable of going into partnership with fintech because of their legacy system. A lot of them they've worked hard to adapt their system, and actually it's going to be good for the future. So that's all I have, Andreas.
Thank you, Julapa. This is very insightful. Since we got the question in the Q&A before, we will be posting these slides so everybody will be able to revisit what Julapa has been saying. And thank you, Julapa, for allowing us to do this. I just want to briefly say that if you have particular questions that you would like to get answered, we have the Q&A open, so it would be great if you could post questions there. And then eventually when we have an open discussion, we will make you also talk in person. Now, I want to quickly move on to the next speaker, who is Neil Weschler. Neil is a lawyer by training, a fintech founder, and he is now the Chief Executive Officer of On Deck Canada. On Deck Canada has advanced approximately $500 million worth of small SME loans in Canada. And Neil also has a second hat. One major reason why he's here is he serves as the chair of the Canadian Lenders Association. The CLA supports innovative lending nationally, including the technology and business processes that are transforming our financial industry. And the CLA promotes transparency and fosters responsible and ethical lending practices. Now, what Neil will do is he will set up the Canadian landscape, tell us about generally alternative lending in Canada, and set the stage for the bigger discussion whether or not the fintech lenders are or are not ready for the particular program that we're talking about in a second. Neil, the floor is yours.
Good morning. So first I want to thank Rotman School of Management, with particular shout out to Dan Richards and Kathleen Colson, and to you, Andreas, for putting this together and for inviting me. Let me start by just framing it. I am the CEO of On Deck Canada, as you mentioned, and also the chairman of the Canadian Lenders Association. On Deck is a leader in Canada for small business lending. We are a subsidiary of a New York Stock Exchange listed company in the US, which was one of the early innovative lenders to launch following the financial crisis of 2008, and was a pioneer in the use of data analytics and digital technology for non-bank real-time lending. Us in Canada as a subsidiary, we do things a little bit differently, but in general, we have three main product lines. We issue term loans, lines of credit, and what we call flex funds. Our average loan size is about $45,000. So given that On Deck has experiences in the US and Canada, and as well as in Australia, we're able to look at what the various jurisdictions do in terms of product offerings and in terms of being flexible to provide credit to the smallest of small businesses in those jurisdictions. Turning to my second role, as you mentioned, in terms of being the chairman of the CLA, I was asked to become chairman about 10 months ago, and if I had a crystal ball to see what the last 10 months has been, I'm not sure I would have accepted, but seriously speaking, I think it's been wonderful to see all the members of the CLA come together to exchange ideas and to ensure that the lending group, the non-traditional financial institutions that form the CLA, come together to support the small businesses and consumer borrowers that aren't served by our traditional financial institutions throughout Canada. But today, the CLA has actually evolved. Over the last number of years, the CLA was put together by a group of innovative lenders that were all different levels of maturity, from small disruptors to larger entities. But today the membership is one that's comprised of our traditional financial institutions. In fact, 2 of the big 6 are members. And we pride ourselves in being a key element of the financial ecosystem throughout Canada. Next slide, please. Kathleen, next slide, please. So when we talk about small business lending and the growth of small business lending, truthfully, the small business lending landscape and the fintech landscape grew out of the 2008 financial crisis. Fintech lenders are lenders that use innovative means, data sources that weren't available previously to judge credit. We make decisions quickly and rapidly through using these adjudication processes, and we provide credit to small businesses across Canada using such innovative techniques. Let me make a very, very important point here as we discuss the inclusion of the financial technology ecosystem in the distribution of credit in the time of COVID. It's been mentioned that because the fintech community is not regulated, therefore we can't participate. My argument would be, and a fact is, that in terms of AML, KYC, information security, privacy, OFAC, and the like, even though not all fintechs are created equal, the development of the fintech ecosystem over the last 10 years or so has evolved to the point where today, many fintechs in Canada have the processes in place that allow for all of the standards to be met, whereby, as much as possible, we can ensure that loans are getting to the right merchants, the right consumers, in a reliable way. So again, we emerged out of the 2008 financial crisis, and even though we aren't, quote, regulated entities, we are entities that in general have best practices and operate as though we have a high level of confidence in our ability to distribute these loans. And in fact, we've disrupted and we've participated in payment processing industry, international money transfers, and we have disrupted investment management and trading. So the fintech community in general is one that's continuing to grow, evolving, and playing a key role in the ecosystem, not only in Canada, but throughout the world. Kathleen, next slide, please. If we consider the impact of COVID, the government has been tremendously receptive to comment, to input of the fintech community. And in fact, I would argue that has been at the forefront of trying to listen and learn how to fill the gaps behind the programs that have been rolled out to support small businesses and consumers, obviously, throughout the country. In fact, I would point out 2 main programs that the government very, very rapidly, through our traditional FIs, put forward to support small businesses across Canada. That being the CEBA program, the Canada Emergency Business Account, and the BCAP program, the co-lending program. These have been rolled out through traditional financial institutions to support small businesses, and they've been very, very effective. And we've been helpful, both as the CLA and the broader fintech community, in identifying gaps so that the government could fill those gaps and provides more support as things kind of evolved and the economy played out. Those loans are typically $40,000 loans, of which $10,000 is forgivable. But even as those loans were rolled out, problems have been identified. And many small businesses, and the numbers are in front of you and they speak for themselves, 50% of merchants, small business merchants, have reported a decline in sales of at least 80%. And this was through a national survey that was done by the CLA to over 100,000 small businesses that form part of the portfolio. And importantly, what they report is that at least 50% of small businesses had no choice but to lay off employees, and many small businesses, our typical bars, restaurants, travel and leisure industries, the dry cleaner in local communities across the country, almost a third have reported that they're likely to go out of business by the end of July, unless there's more support coming behind it. So while there's much comment around what's next, and while the government has been tremendously receptive, not everything that's been done is going far enough. Next slide, please, Kathleen. How do the fintechs play in the landscape, or why have they been excluded? Well, as was mentioned previously, in the United States, through the PPP program, the fintechs were included. Fintechs are also included in the UK and Australia. Why is this important? It's important because of the fact that lending continuity, a theme that I think we should all keep in mind, is one that's important. Remember, the borrowers that are the small businesses in all of our communities across Canada were provided loans through CEBA, through our traditional financial institutions. Those financial institutions typically didn't have credit relationships with those borrowers pre-COVID, meaning they may have had checking accounts, but they didn't provide credit. We, the fintech community, did. We had pre-existing credit relationships. We were excluded to provide credit to those customers, tens of thousands of small business merchants across Canada that we previously had relationships with. We were not allowed to provide credit to them through the CEBA program or any other program. And it's not an and, an or. We can sit alongside the financial institutions and provide this credit, because I think we all know that pre-COVID, where the traditional Canadian FIs weren't providing credit because of a lack of collateral. We, the fintech community, are cash flow lenders, whereas our traditional financial institutions are collateral lenders. We, the fintech community, should be included in the ecosystem because we need to have a continuity post-COVID to allow those businesses to exit and to grow. So I'm happy to take any questions, and I can speak for the fintech ecosystem that we're passionate that the small businesses not only get through COVID, but succeed thereafter. Andreas?
Yeah, thank you so much, Neil. I'm not going to ask you questions right now. I want to speed up a little bit. But we have an extended Q&A in a minute. And so I'll come back to you on that one. At this point, I would like to loop in Senator Colin Deacon into the discussion. And we're going to have a very brief discussion about some topics here. I'd like to squeeze out some information from him. Now, Senator Deacon has been not only he's not only a senator, an independent senator from the province of Nova Scotia, he's also been a successful businessman and entrepreneur. As a senator, Colin has been highly engaged on the Standing Senate Committee on Banking, Trade and Commerce, and he is known as an advocate for fintech. Now, as you can see from the, I'm so sorry, from the composition of this panel, there is really nobody who takes the role of telling us why the contrary view as to why the Outlanders were excluded. So I'm going to try to take that role a little bit, and I would like to maybe help Colin or Senator Deakin, I should apologize, to help me with this to the decision process. So maybe Colin, can you walk us through the process? What would have happened in the room when the decision was made? And now, to be clear, when you look at the website of the CBA program, it's so it seems like it's been like something that's going on only through the big banks, but actually it's, on total 230 different institutions were allowed to process these loans. So many of them include the credit unions in Canada. So it's not like it was just money which was thrown at the big banks, and that we only trust the big banks to be doing this. But Colin or Senator Deakin, maybe can you run us through the decision process a little bit? What could have happened?
What could have happened? I've been struggling with that question, Andreas, and thank you for inviting me to join you today. And I struggle with it even more after seeing the previous two presentations. Neil's data are very troubling, that a third of small businesses were not able to access CBA, 85% were not able to access BCAP. These programs were put in place to help all Canadian businesses to survive this crisis. And I think you've got some really great insights from the initial presentation that we had from Jalupa that was just phenomenal to understand why fintech lenders have been so successful in reaching and successfully lending to those that have not succeeded in securing loans from traditional lenders. The other thing that I think is really important is that we're not talking about institutions that are dealing with the same customers in general. We're talking about different customers between the banks, credit unions, and fintech lenders. So I think that's really important because it reinforces the word that Neil said, which is it should be and. It should be banks, credit unions, and fintech lenders. What's the reason? I haven't been given good reasons, to be honest, and I can't understand them, but I think probably there's just a reluctance. You look at how the FCA dealt with the fintech opportunities in the UK, and they leaned in when they didn't understand. They set up a sandbox 5 years ago to start to understand what these financial technology companies could bring to the financial system and how they might be regulated. They didn't push back and say, ooh, I don't understand this, I'm not comfortable with it. This might be illicit activity versus innovative activity. And for me, that's a really big difference between Canada and the UK, is that the UK has leaned into this and really understood and worked on it. 2 days ago, Finance Canada just issued another $259,000 contract to continue the process of preparing for consultations that will be done by the end of December. So we're going to continue to consult in Canada when we've got businesses that are dying on the vine, that need the support that is available to them if Finance Canada were to embrace the innovation agenda in Canada. And that's probably the thing that has me most concerned, is that Finance Canada is operating separate from our innovation agenda. It's not saying how do we incorporate these opportunities for productivity growth and increased competition, but pushing back from that and saying, no, we'll be the governor on the system and not encourage that to occur. So, your question is, why was the decision made in the room? I think it's just an abundance of caution. Don't make changes when we've got too many other things to do. Let's just do the easy job here of we can do a deal with the banks and get the money to the banks and start getting the money distributed. But what I worry about is not the time from when you make a decision to when you get the money into the financial institution to lend out. What I worry about is, when does it get to the groups that need it most? That's the metric of time that matters the most to me. Because the money is not, it's not about getting money flowing through banks, it's about getting money to the businesses that need it most. And what we've seen very clear from Neil is that isn't happening through the current approach. So that's what worries me. The opportunity of using different new metrics to serve the same businesses is just so fantastic. And that increased competition, the interim competition commissioner has been very clear. We need to reduce the friction of allowing people to move between financial institutions, and we need to force banks to compete harder for their consumers. So there's so much opportunity out there associated with this. I don't understand why the choice is just to continue to consult, but not take on a very careful approach to integrating fintech lenders into the government programs at the time of greatest need. I'll stop there.
So now, if I take the other side for a moment here and ask the following question. Now, in some sense, the financial institutions are really just pass-throughs, right? So all that they do is they process their loan and they receive a 40 basis point fee for it, as I understand it. Now, if you look at the criteria for the eligibility, they are quite simple, right? So you have to have an operating business, you have to have a federal tax registration, you have to have employment expenses and some non-recurring business expenses. So it seems very straightforward. And if you as a business have made a tax return, that's something which you can easily prove. So the question is, there's two questions there. I mean, you can take two perspectives, right? You can ask the question of, this should be so straightforward that anybody who ticks these boxes, and these are very simple boxes to tick, they should be able to prove it very, very straightforwardly. So the question is, why do we need the fintechs for that? And so is it really true, or maybe Neil can also chime in on that one in a second, that there are these businesses that somehow fill these eligibility criteria, but they have not been served by the existing financial institutions? Or what is it that fintechs for something as simple as that could possibly do that banks cannot do?
Yeah, I'll use the example from the United States with the Cross River Bank, small community bank, one branch that did as much lending as Wells Fargo, Bank of America, JP Morgan, Citi, in terms of numbers of loans, but the loan size that they were processing, because this community bank, and this is a lesson for our credit unions in the country, I'll tell you, this is why the credit unions need to really pay attention to the opportunity here, because this one small community bank was fintech empowered. It did deals with a lot of the fintech lenders, and their average loan size was $38,000. So their priority customers were different than the ones that were being served by the banks. I think the banks were, I can't explain why. You've got the levels of decline in application that you've seen, or blocking of applications or unsuccessful applications, and SEBA and BCAP. I don't understand why that's the case in Canada, when, as you say, the criteria seemed quite simple. But what we've seen in the United States is fintech lenders are able to succeed tremendously at dealing with a very different type of customer than the big banks. And that's great. They're not competing. That's why this should be an and why I'm very discouraged, to be honest, that in the last 2 days, we're seeing just continued consultations. And I think probably an indication that we're not going to see fintech lenders brought into the recovery phase, which they are desperately needed in the recovery phase from COVID. We need to increase productivity and competition. So I'll leave it there, because I know you've got others that you want to speak to, but.
Yeah, no, so that's okay. So let me read out a quote from Aaron Bowles, who's a spokesperson for the Canadian Bankers Association, and he talked to The Logic. Now, and this will be something that I would like to address Neil first. And he says essentially is that you get this perfect situation where the pandemic hit. Canadian banks have made over 100 billion in technology investments since the 2008 financial crisis. So that's a very sizable amount. So if you take it for the big banks, that's like 20 billion each. Sounds really large. I'm not sure how much that relates to anything that they normally do, but it's a large amount of money. And suddenly there was this need for automation and capability, and that spend was already in place. The technology was resilient, it was tested, and the federal government needed a trusted, fast, ready-to solution from established institutions that Canadians have over the centuries come to know and trust. So in other words, this is a trust issue. And he said that, and in these urgent circumstances, trusted and proven institution like Canada's banking sector was the choice the government made. Now, this goes along with many of the statements that you hear from financial. So clearly, first of all, the fintech firms have made tremendous investments and tremendous advances, but they haven't spent $100 billion, right? not as a combined investment. Whether or not that's a necessary question is a different point, right? If you have to, banks still run on COBOL, many of their systems. So, maybe that's something which they should have done a long time ago. But the one thing that you hear from banks often is that fintechs are just not ready. And maybe it's possible that Canadian fintech firms are just not as ready as, the UK or the American ones. Neil, what do you think?
I find something. Go ahead, Neil.
Sorry. Oh, I think it's hogwash, and let me make three very quick points, and one of them Senator Deakin made better than I ever can. It absolutely is and. This is not. It's just not about the banks should be included and the fintechs should be excluded. Why can't it be an and? Because we can reach certain merchants that the banks typically don't reach or don't want to deal with. Almost all of the big six, if not all, have continuously represented that loans under a certain size are unprofitable to them. So it's only in this time of COVID where the government is there supporting these loans did the banks do a fantastic job, frankly, of setting up the CEBA program quickly and efficiently. So I would say it's an and. That's my first point. My second point would be, again, going back to the continuity in lending. I will guarantee you that as these small businesses hopefully start emerging from the lows of the low of COVID, they're going to require capital. And if the government isn't there to support these loans through the traditional financial institutions, I guarantee you they're not going to be providing those loans. So who will be there? The fintechs were there in 2008. And if we are able to manage our way through this, we'll be there later. So it's the continuity in lending. And then lastly, I would argue that there are unintended consequences of what the government is doing by excluding fintechs. And that is that over the last decade, the Canadian fintech ecosystem has grown and flourished and produced wonderful companies. Some of them have become global companies, and we are undermining innovation in Canada by excluding the fintech ecosystem at this time of need. And one of the unintended consequences is going to be to set us backwards in all of the efforts and strides we've made over the last 10 years, whether that be in open banking or small business, consumer lending, or any of those areas of fintech where Canada has been, frankly, a leader because of some of the support that it's received.
And Neil, I'll just add one or 2 points, and that's that I don't believe that Finance Canada understands the harm they're causing by not including fintech lenders in the mix of solutions, and by choosing the or word versus the and word. They have these businesses have worked hard to provide value to their small business customers. They're serving an edge of the market that is not otherwise being served. And as somebody who's built businesses and fought to get new customers, now that the Finance Canada is forcing as a fintech lender, be forcing the fintech lender customers to head back to the lenders who didn't want to work with them in the first place, and breaking that relationship. And the phrase you used, Neil, that I really liked is lending continuity. When you're at the time of greatest need, you should be able to deal with the group that understands your business the best. And there's different metrics being used by fintech lenders than by our traditional lenders. And I'm not saying one's bad and one's good. I'm just saying you need both. You need it all. It should be and that's what I find so really concerning, is that our innovation agenda is not understood by, and the harm that's being caused by this is not understood by Finance Canada, and we've got to find a way to get through to them.
I want to quickly let Julapa chime in here. So Julapa, you've spent some time thinking about the implementation challenges that have arisen. If you compare the challenges that you see in terms of mishandling of the applications and so on from the legacy system relative to the fintechs, would you have any way to compare the two? Can you say something like there's fewer problems with the alt lenders, with the fintech industry, or are there more with the fintech industry in terms of implementation concerns, at least in the US, where both were involved?
Okay, so first, let me also add to what Neil and Colin just said, that about the lending continuity. So this crisis actually we all know that it's much different than the previous crisis. And so this is what we call self-imposed recession. And regardless of the source of the shock, we're gonna see that at the end, to go through the recovery, we're gonna need fintech lenders again to really support the small businesses and other, for the basically the economy overall to recover at a decent speed. And so by not supporting fintech now, and if they don't make it to the end, we're gonna lose that benefit. And so right now, not only that, so in Canada, if they're not allowed to make loans, I don't know if they are eligible themselves to get the loan themselves to support, to keep their employees. In the US, it's not. So they're not eligible for that. So a lot of layoff and furlough in the fintech industry. Now, in terms of applications, processing applications, because this is a SBA program, Small Business Administration, and it used to be that annually SBA would make about 25 billion of loans per year. And now we are talking about 350 billion in 8 weeks. So it's just impossible. The system is not built for that, right? And so it was mainly manual. So the transition from the existing system to whatever it needs to handle this huge volume, fintech could help, but still there is a lot of digital transformation that needs to be done. A lot of fintech, like TD, for example. So it's one of the sponsors of this event, right? It's actually in our district, Philadelphia district. And so a few weeks ago, I had an event here, virtual, that invited TD speaker to talk about how COVID impacted their firm. Of course, they closed a lot of branches, but actually they said they were watching very closely all the discussion around PPP. And so within 72 hours or something after it's announced, the program started. They had this app, some process to be able to actually not depending on just manual processing, but they have a lot of electronic process to help expedite the application. So they have done that. And TD actually partnered with a fintech firm, Amount, that helps them behind the background with a white label. So people don't even know that Amount is doing some of the things. But and they're actually, a lot of IT people work hard to develop that. Many fintech lenders are trying, but of course, their duplication of the applications is key because everyone is trying to get a loan to make sure they get a loan. So submit a lot of applications, and they can only get one. Once it's approved, other lenders actually don't know until they finish processing, submit it, and they say, okay, it's canceled. So that's something that maybe in the future when we have more time.
So I'm so sorry to interrupt you at the very end, Julap, but we have only 2 minutes left and we have a hard stop at 11. So I want to quickly address some of the questions from the Q&A, and I'm going to collate two together. Basically, they're asking about the collaboration between fintechs and legacy institutions, and also the role of Shopify that has a lending arm by itself. And this is a question to Neil, and you have to answer within 1 minute. Is this not an opportunity where the fintechs actually can step in and help, in particular, maybe some of the credit unions and smaller institutions that will not have the same systems in place to process these loans quickly? The amount of money to be earned is only 40 basis points, so maybe there's a way how they can actually squeeze out something profitable from this.
So very quickly, we at On Deck are partnered with one of the major banks, one of the major credit unions in Canada, in terms of being a senior lender relationship with one, having a distribution deal with the other, and we've reached out to all the major significant Canadian FIs, credit unions to provide assistance in distribution of funds. But again, there's been no direct involvement with government accepting that we reached out our hand in cooperation, but it hasn't been shaken yet.
That's disappointing to hear. Colin, I hope that, or Senator Deakin, I hope that you will be able to push this agenda forward a little bit so that, there can be a larger expanse. Now we are at 11 o'clock. We have a hard stop at 11 o'clock. And so therefore, I unfortunately have to cut this very interesting discussion short. I think we could go on for another half hour and elaborate further. I would to thank all of the attendees for listening in to this presentation and this discussion. And I want to thank the panelists, Senator Deakin, Neil, and Julapa for their presentations and their points of view on this. And we'll see you soon for the next event. Thank you so much, everybody.
Thank you.
Thank you.